excited to talk about how to make your fundraising a little more fun, or at least a little less stressful. So let's just jump right in, and I'll give you a quick background on me. Here we go. I think I got it to move the slide. I've been in tech startups for, over 20 years now. Been a tech operator for a really long time. But I'll tell you my origin story for starting Scroobious, which is a startup too, and I have fundraised for, and we'll talk about that. But prior to Scroobious, I launched and ran a medical device company that was spun out of MIT and the Leahy Hospital System here in Boston. And I was the business one on the team, so I did our fundraising. Raised about 10 million for that company over the course of 5 years before it was acquired. But for me, what really defined the experience was the gender bias that I encountered in the fundraising process itself. You'd think I'd have gone through everything already being a tech operator. I'm quite used to being the only woman in the room. This was different. So I spent a long time researching the space of fundraising and pitching, trying to understand if my experience was typical or atypical and how that whole process works in general, because that was my first time in that space. And you very quickly encounter a lot of pretty heartbreaking statistics. We're going to go over some of those in this presentation, and this is not specifically about that, but I think it always helps to hear someone's origin story before they start talking. And I saw a real need for education in the space of fundraising and pitching, and how do you understand how investors think and what they are looking for so that you can communicate an investable opportunity for them. It's really opaque, that area, and it's really hard to find accessible and affordable education in this space. So that's what we're doing with my company now, Scroobious, and why I'm here talking to you about it today. So I'm also a really frequent advisor and mentor and speaker. I'm quoted in the press. I'm also an angel investor myself. So startups, fundraising, investing, that is my whole world right now, apart from my family. And I'm very vocal about parent entrepreneurs as well. I've got 2 kids. We are amazing at startups, in my non-biased opinion. So we have so much to cover today. And I should say, this feels so funny to me, Jippy. I can't see any of you, so I hope everyone's keeping along. But if you have questions, please put them in the Q&A. Rachel is going to monitor that, and at the end of the presentation, we're going to go through all the questions. I'll make sure that I leave enough time because we're going to cover a lot of stuff today, and I'm sure there will be some. So write it as soon as you have it so that you don't forget, and then we'll come back to them at the end. All right, normally I'd ask for everyone to give me a thumbs up, but I can't see anyone, so I'm just going to hope that there is a lot of thumbs up going on. So here are the questions that we're going to go over. This is going to be the flow of the presentation today. And we're talking about fundraising in general, not just pitching. My normal stuff is all about pitching for anyone in the room or online who's seen one of my workshops before. But first, we're going to talk about how we find the right investors for us. So much of fundraising is finding the right people to pitch to. That is a huge part of it, and I don't think it's talked about that much. The kind of like boil the ocean approach is not what you want to do here to respect your own time. And then what goes into a strategy? How do you think about fundraising a little more holistically? What's a comprehensive strategy to help you out? And then how do you create that compelling narrative? We're going to touch on it today. I'm going to give you a high level. And then for anyone, again, who knows me, I've got way more on that. When should you think about raising your next round? How do you think about that chronologically? And then how much money do you need to raise? What should that round look like? So we're going to hit on all those things. All right. Number 1, how do we find the right investors? So there are a lot of types of investors, which is really exciting. And I think for a lot of founders, our minds immediately go to venture capital, right? This is what's all over the place. You know, if you're on Twitter, Twitter is huge. Everyone's talking about VC. VC is an option. But it is not the only one. So we're going to talk a lot about the other ones as well, because the landscape of how you can capitalize your business and your startup is really expanding and changing. And that is a good thing. That's exciting. But let's start with VC. So first, just to understand the VC persona, and I encourage you to think about each of these types of investors or types of capital sources as personas. Just like you would make a customer user persona, you have to understand the investor user personas because they are different. They operate differently, they have different motivations, they have different needs, and different things will be compelling depending on who you are trying to get investment from. So a VC fund has limited partners or LPs. That's the money that the general partner or the GP is investing. So the GP might also be in that fund, but they're not only managing their own money. If they are, they're managing a bunch of different people's, organizations, companies' monies that are in that fund. And that's really critical to know because it's a core difference between a fund and other types of investors is they have LPs that they have fiduciary responsibility to. That means they have to have their investors' best interests at heart when they are distributing their capital. So they take a portfolio approach, right? They have to look at their full, what is in their portfolio? What are they investing in as a whole? So while your opportunity might actually be great and right in thesis and something that they'd want to get behind, it might not fit in their portfolio. So they have a different view when they're evaluating opportunities. It's not just your one opportunity in a vacuum. And they are exposed to so many pitches, 5,000 plus pitches a year. They are getting literally 100 or more pitches that come across their inbox every day. They're inundated. And that's, when you hear that they don't have a deal flow issue, a lot of it is that it's quantity, that they have so much inbound. And it means they're seeing a lot, right? That's good to keep in mind too. They are seeing way more of what's out there than you are aware of. Because just like your own company, if we're at the early stage, not a lot of people know about you, but those funds that they're pitching to, they do. They see that inside view. And they typically have a pretty structured thesis that they set some boundaries around so that when they talk to their LPs and when the LPs are giving them their money, they know, okay, this is the thesis. These are the guardrails they're using for how they're putting my money to work. And they typically have a process, right, where you need to go through some sort of structure with them, and then they're going to present to their investment committee. They have to pitch you to more people at the firm. So just some basics to understand about the mechanics of VC. And remember, if you have any questions about anything, put them in that Q&A. This is a bit out of my element, not having some back and forth here. My normal presenting is a lot of engagement and back and forth. So help me out and put some stuff in there so I know that people are, or give me a thumbs up in the chat so I know that everyone's following along. Okay, so a little bit more about VCs. I want to talk about what this looks like in reality for underrepresented founders. I know not everyone listening to this might identify that way, but a lot of people do. And it's really important to know what is realistic for you so that you spend your time in the right way and make the best use of it. Awesome. I love the thumbs up. Oh, a happy face. Fantastic. Nice, Mark. I like that. All right. So just so you know, VCs, 96% of deals are sourced direct from their network. Huge number, huge thing to understand. And 89% of them use warm introductions or referrals. So this means, oh my gosh, I love the gifts coming in. Dan, love that. So this means that, you have to be aware when people talk about how it's hard to get into VC or you need that warm intro. You might hear a lot of people talking about how they don't like warm intros and you fill out a form on their website. That's great. I'm a huge fan of not using warm intros. And in fact, there's some research that shows that cold inbound has produced better investment results when they invest in those companies. But this is a reality. So it's great to say we wish the world was different. And I hope it does change, but this is a reality and you have to be aware of it. And some of it is making yourself get in those networks somehow. So what can you do? Oh, this is coming up in a different slide, but more just facts to know so that you know the reality of things. There are a ton of startups. There are more than 1 million startups that are less than 5 years old in the US. It is a huge number and it's growing. There's more every day. Uh, when we look at VCs, again, we're talking about just VCs. We're going to move on to other types of capital sources. But for VCs, almost 98% of partners, of check writers, are men. Again, stuff that you should know. That means 93% of VC dollars are controlled also by white men in particular. And women and people of color, other underrepresented groups, on average, the bar, it's 2%. We get 2% of VC dollars. For other groups, it's much, much less. If you're a Black woman, it is, I think, like 0.67%. Really, really systemically low percentages. So if you fall into one of those categories where you identify as underrepresented, really think hard about your fundraising strategy, because you should go into it. If you're gonna pitch funds, it is by no means impossible, and you should go for what is the right capital source for you, but be aware, have a clear head of what you are up against. It is, your chances are much lower, and it is systemic. So when you get a lot of no's and you get really frustrated going, what's going on? Why am I not making progress here? So it is not necessarily you and your opportunity. So, you know, keep that view as well. There's always stuff that you should learn what's going on and why are you experiencing issues, but this is a systems issue, the capital allocation to underrepresented groups. So try as hard as you can not to take everything personally. It's really, really difficult to make inroads or gain investment when the people writing the checks are extremely homogenous. It just is. It's a nature of human behavior and how venture capital has evolved over time as a capital class. So, you know, I just like everyone to be informed and aware. And it is frustrating because Black women founders are 3 times the share of their representation of the population. Same Latinx women founders, 2 times the share of their population numbers. So again, right, system problem there. And when we look at VC firms, 2% of them are owned by women of color. This is growing. We are seeing way more emerging fund managers come out every day. There's someone with a new fund. Awesome, encouraging, but also know the reality, they raise less. They raise far less for their funds. They encounter the same systemic bias issues that founders do in getting LPs to write them bigger checks. So they in turn can't write as big checks to the founders that they're investing in. So be aware of that. Every fund is not the same size. Every fund is not writing the same size checks, and emerging managers often have what are called micro funds, and the size of the check is actually pretty similar to what you get from some angels or angel groups. Again, nothing wrong, but just know that that's the case, and that this is what's behind the numbers that we see and why there is this systemic block in venture capital itself. All right. So what are some things that you can do? I suggest doing all of these as early as you can, even if you are not raising from venture capital right now and you maybe think you might later, still do these things. I can tell you, I just finished an angel round for Scroobious. I'm doing all these things. I have been doing all these things from the beginning. You can't do them soon enough. So one, knowing that warm introductions are a thing that you're going to have to deal with. And if you are not connected in that space, that's very common that for underrepresented founders, that you've been historically blocked from investors and other startup networks. One of the best warm introductions you can get is from a current portfolio company of a fund. So I really recommend, I don't think founders do this enough. If you have funds that are on your dream list or your target list for some time, either now or in the future, go look at their portfolio. Stay up to date on the portfolio. Find CEOs or founders in portfolio companies that you can reach out to. Ask them if they might be willing to share their own views or their own journey of fundraising with you. Ask them how they feel about the investors that they have on their cap table. Get to know them and develop a little bit of a relationship. And then you can ask that person for a warm introduction to the fund. It is one of the best ways to get in. Steve, it is a party in this chat. I am loving these images. So another thing that I encourage you to do is to research the partners at the fund, not just the fund itself, because this is a people business. Fund managers, angel investors, whoever it is, people invest in people. So definitely look up the fund itself and everything on their website and Crunchbase or PitchBook or wherever you're getting your information, but look up the partners. Who is the right partner for you to start developing a relationship with? That's what you need to know. But not only that person, look at the rest of the partner team. Does this look like a team that you would want to work with? Because partners sometimes leave, they do. And then you will have a new partner assigned to you. And you want to make sure that there are some other people in that fund that you would want to work with. Because your partner, your lead in that fund, they're your champion in there, right? They're the one that you have this great relationship with, and they are in their fund almost representing you. And I've had this happen to me, right? And lots of people have, where there's a change in partner and your relationship drastically changes. So it's another thing. I like to point out things that I think can be opaque or founders might not be aware of, but that is something definitely to know. Look up the full team. Try to establish some relationships and rapport with more than one partner, so that if that happens to you, you're set up well. Okay, another big point. Every meeting, whatever meeting you have, if it's informal, if it's formal, go into it wanting more time. Your goal should be, I need to get another meeting with this person and I want them to bring more people. Don't go into a meeting saying, my goal is to get a check. I need to get a check from this person. You're going to have the wrong energy and you're going to focus on the wrong things in that meeting. It also damages that rapport building. If your goal is get a check, get a check, get a check, you're not looking to build a relationship. And that's what leads to the check. Sometimes it's years of relationship building and proving your trust and your rapport with those partners. And then the check comes really easy at the time that you're ready. But you need to go through all of that. And so just go into every meeting genuinely wanting to establish that connection and get more time rather than the check. And then a great tip too, be active on social, in particular Twitter and LinkedIn. Investors are all over it. Fund managers are all over it. And it helps establish your credibility and your thought leadership. Right? One of the very first things a fund manager is going to do is try to find information about you and your company out there on the web. At the early stage, you are the company. They are giving you their money. You are the steward of their capital. Have some thought leadership, have some presence out there. They're looking for it. And it's better, you got to do it consistently over a long period of time. It has done amazing things for me in my business. It's a good use of time, and get yourself in that habit of consistency and delivering value over those networks. Okay, I see some questions coming in, but I'm gonna wait till the end. But keep them going, keep typing them in, because Rachel's keeping track over there. So the next source of capital that I would think about are angel investors. At the early stage, if you're Series A or earlier, this is a great source of capital. It really is. Angel investors can invest in a number of ways. They can do it direct, they can do it through groups, they can do it through a syndicate. There's other ways as well, but I'm going to talk about angels as individuals and then angels that form groups. So with angels, a lot of people don't realize the scale of how many accredited investors there are. In the US alone, there are more than 4 million actively investing. And that's an undercount because there's no really great way to get this data. So millions of angel investors, that's like not an exaggeration. And they have a different motivation. They don't have LPs they have to go report to. They are just investing their own money. That is a different motivation. They don't need to go report that they successfully earned some multiple of investment to other people because it's other people's money. It's just themselves. They often have some pretty great experience and operational expertise that they can lend to you. So they provide a whole lot of value besides just the check. And it's one-to-one, it's relationship building. Again, it's discretionary money on their part to invest. Now, a lot of angels will join angel groups, and those are run a little differently. So typically, they'll form a group around something. They are, looking to access increased deal flow. They're looking to collaborate on due diligence in particular, and they're looking to pool their capital so that they can write larger checks versus the individual size that they're writing. Usually it's regional. Maybe everyone's in the same location. There's a lot of angel groups in Boston that came together because everyone is in Boston. Maybe it's around a thesis. Maybe it's alumni of a university. Maybe it's around particular expertise. And you usually have to go through a process when you apply to them. They almost operate like a fund or like a micro VC because they're managing a group of members. But just keep in mind, these members are still angels. They are still writing their own checks and deciding what they want to do with that. It's not the same as an LP situation. So let's look at who is the angel, right? User personas. These are user personas. Things to know about angels. Again, there's 4 million of them actively investing. 3,000 will make their very first investment this year. That is a lot of emerging angel investors. I'm one of them. I got into angel investing this year. I've done 5 of them, and I have very different motivations for getting into this space than I would if I was a GP or managing a fund. As a whole, we invest 25 billion in startups annually. That's a lot of money. This is an actual capital allocation class. It's not just your uncle out there who's going to write you a check. And they are a different demographic. There's a lot of women, people of color, younger generations, new regions, and they are really focused on intentionally investing and looking for DEI opportunities. Very different, again, than venture as a user persona. About 30% of angels are women, which is a huge number comparatively, and they care about the gender of the founder they invest in 10 times more than men do. And remember, our user persona for a GP, for a VC fund, what was it, 96% more, 98% men? So very different. They're also looking for that diverse deal flow. They're looking for deals that they can get involved in. They're looking for founders that they want to back, where they can provide a benefit to that founder. And a lot of them are outside of the hubs. 63% of them do not live in San Francisco, New York, or Boston. So they're all over the place. It's a really good class. So we get asked a lot after we talk about angel investors and how great they are. Okay, how do I reach them? So this is my general advice for how to reach them. One, do what we just were talking about. Think about your own company and create the persona for your ideal investor. Think about who is a person that would just get it. They would just get what you're doing. You wouldn't have to go through your whole pitch. You wouldn't have to like convince them of something. They would see it and they would get it. What kind of a person is that? What career have they had? What kind of life do they have? Where do they live? What are their demographics? Create that persona and expand your view of who that could be. Remember, there are millions of actively investing angel investors. Think about executives in your industry. Think about, maybe if you're in healthcare, you're a doctor. If you're in fintech, you're a bookkeeper, you're an accountant. Consider all those people. They might angel invest. Other founders angel invest a lot. Think about all those things. Then when you have a list, when you have your persona, you're going to make a list of some targets who fit that persona. You may or may not know them. It's okay if you don't know them. Try to find people who would just get it. And you're going to send them a personalized email, actually personalized. You're going to start with something you found about them. Can you find a quote that they've given somewhere? Are they active on social and you can find stuff they've said? Does the company they work for, did they do something that you can use that you want to reference? Make it clear in that email right off the bat that this is not a form email, that you are not sending 100 of these to people. It takes a few minutes of research and figure that out. And you should have already done some on them to know that they fit your user persona for your ideal investor. And then in that email, you're going to ask if they have 20 minutes of time. If you could really, you really value their feedback. They have such great experience, so relevant. You're working on this thing. You could really use their advice or use their feedback. That's the ask. Lots of people will say yes. A lot of people will say yes to that. And then, just like with DVC, where your goal is get more time and don't focus on that check so much, when you get that 20 minutes, your goal is to listen and get some good advice. It's not to get their angel investment check. This is a valuable call in and of itself. You're connecting with someone who has good experience in your space, and they probably have a good opinion, and you'll get some good stuff out of that phone call. Just that. Do what you said. Ask for their advice. End the call. You're going to do a follow-up email. You're going to thank them so much. You're going to tell them something specific that you got out of that call that you really enjoyed, that you're mulling over, that you can implement. Something, again, personalized. Ask for more time. Ask for another call. You're building rapport. You're building a relationship, so you are a known entity now. In that call, at the end of it, if you feel that energy and you're feeling good, then you can bring it up and you can say, hey, do you ever angel invest? I'm raising around and I'd love to bring you in, have the opportunity for you to help, make our equity really valuable on this journey and have you see a profit from what we're doing. Do you do that ever? And they might say yes, they might say no, and that's fine. And you say, that's totally get it. Do you know anyone else who might be really interested or get what we're doing? Because the chances are higher that they do know that person, given that they're in that user persona. And if they don't angel invest, okay, you've made a really valuable contact and friend in the industry, and who knows how helpful that's going to be. So go into it with that mindset, and you'll be surprised at how quickly you grow your network with genuine relationships instead of just spamming out 100 emails and wasting a lot of time in meetings with people that are not going to ever give you value. Okay. So next thing to consider, a lot of people don't think about them, are family offices. Family offices are really increasing their direct investment activity. And they look for startups that specifically are in the domain of expertise that will either be strategic to the family's business or where they can provide really good value or where they are very passionate or care about what you're working on. So immediately there's a little bit more alignment if you find that office that fits one of those criteria. And it's more like pitching to an angel than pitching to a fund. It's really about relationship building. And so just some things about family offices, because they can be a little bit elusive. And I know this is harder to find. This is a harder one, but if you can find one you align with, we had a family office as a major investor in my last company. They're really, really great to have as part of your cap table. So a family office, for those who don't know, this is a family-run business that manages the financial affairs of a wealthy family. So usually, like a long time ago, a part of this family made something very successful, generated a lot of wealth that has grown over the generations, and they have an actual office, a separate office just to manage the wealth of the family. They are often participate in private equity funds. They're often LPs, but they are getting more into direct investing. There are 5,000 or more family offices that directly invest. Again, a little bit like angels, these numbers are not as easy to track as, say, a regulated fund. And they typically have more cash on the books than a VC fund does. That gives them the dry powder, that liquidity that they're able to invest quicker than a fund would, and they don't have to go raise capital to be able to do it. It's the family's wealth. And they work on a longer time frame. They work on a generational time scale. They don't need to report returns for a fund within 5 to 10 years to the LPs who are waiting for that information. It's just within the family. So, right, thinking about who are you talking to, what are their motivations, just understanding that it's different. And then another one is crowdfunding. With the newer regulations, crowdfunding didn't exist that long ago. This is fairly new, and it came under Obama with new regulations. It's another way that you can capitalize that didn't exist before. This is where there are a lot of individuals writing checks that are rolled up into one line on your cap table. So this can be accredited investors. It can also be non-accredited investors because they can write much smaller amounts. So with this fund, with the regulations, so you can open it up. You can get more diversity of who's participating. You can fund, sometimes they're called community rounds, because you can have your community, your customers, your partners, they can participate with lower checks all rolled into one. And it is regulated, so there's a lot of reporting involved, and the pitch is very different. It's much more like running a marketing campaign because it is a much broader audience. It's not the same as that one-on-one rapport building, relationship building. You're really doing a campaign. So there are a lot of different platforms that have come out. I put some logos here you might recognize. This is not all of them. There are a lot of them. And just some, things to point out. There's a lot to learn. If you're considering crowdfunding, you really should do your due diligence on the crowdfunding itself. There's a lot of stuff to consider. And we, even in our platform at Scroobious, we have a whole workshop that we did that is available that is all about just crowdfunding regulations from a lawyer who's in that space to be aware of. But there's some things I'll pull out for you. You can only raise 5 million in a year. So if you're looking to raise more than 5 million, probably don't do a crowdfund. It comes from both accredited and non-accredited people. And there are some investment limitations if you are not accredited on what you can do. You are legally required to have all the information about your crowdfund only on the portal you are using. So all you can say in public is, please go to my crowdfund page. You point people to that page. You can't give any other details outside of that platform because that is regulated to be able to do this. So that's something to be aware of. You are pointing everyone there, right? You're running a marketing campaign. You can market it, but you can't give any of those details. You have to go to the page. And there's a lot of documentation you have to do. You have to give them all your financials, give them lots and lots of stuff because they are regulated. You have to disclose a lot of information to be able to participate in a crowdfunding campaign. And each one is different. They each run based on different business models for themselves, right? Crowdfund portals are for-profit businesses also, so they have their own business mechanics. Make sure you know what terms they are telling you that you need to commit to, what are the fees. Make sure you understand each platform is different. So if you're going to do one, pick the one that is right for you. They're not all the same. And you typically, to have it be successful, you need to seed it with money to begin with. So instead of an angel round, usually you would take that money you would have gotten from initial angels, even if you just have a few, and have them do it through the crowd fund, because you need to have some money in there to make it attractive for other people to participate. And then you market like crazy. So it's not like you just put it up there and then magically your crowdfund fills up. There's a lot you have to do. It's not less work than doing a traditional raise. It's just different work. All right, I'm going to try and move a little bit faster. I'm not pacing my, I'm giving you a lot. So 2, what goes into developing a comprehensive fundraising strategy? So let's look at this one. Something to know, it's inefficient for everybody. I'm going to run through this fairly quickly, but just to give you a sense of timing to expect for a fundraise. These are on average numbers. Again, if you identify as underrepresented, these numbers will be much higher, and it is going to be much harder. But on average, if you're a founder, let's look at the founders, you're on average contacting 56 investors with a real kind of first contact. So assume you spend 30 minutes per contact because you're researching them, you're writing your personalized email, you're trying to network with them, you're sending them your pitch, and you're trying to get a first meeting. That's how many you're contacting. Then, okay, you get a first meeting with 33 of those investors, and these are on average numbers. You're probably spending about 90 minutes. You're doing more research, you're practicing your pitch, you're doing a bunch of stuff. It's not just the one meeting, which typically is 30 minutes. Luckily, if you get 45, you're lucky. And this is where you get to show you. This is where you get to have a meeting with someone and be a person. And that's a lot of time. That's a lot to do. Then if you make it into due diligence on average lasts about 3 months, can be much longer. It can go quicker, but expect about 3 months of them digging into all your stuff, calling around, having more conversations, presenting internally. And here, this is really more about VC, this slide. Angels can go way faster than this. And that's to get your one round closed. Investors, VC investors, they're getting 105 leads. This is to get one deal, to write one deal. It starts with 105 leads. They spend on average 3.5 minutes looking at a deck. When you're a founder, something else to be aware of. You get 3 minutes. That's generous of an investor deciding whether you're worth a first meeting based on your deck. And this is where they're looking at warm introductions. That restricts access. It eats up time. And of those 105, they'll take meetings with 21 founders of that group. About 45 minutes a meeting. They're going to, maybe it's a half-hour meeting. They're going to do a little bit of looking at them beforehand because the deck does not give enough information. And then diligence, same amount of time on both sides, right? So this is an inefficient process all around. So when you're thinking about, okay, well, now what do I do? How do I prepare for that? The more you can prepare in advance, the more headaches you'll remove for yourself. So just some big chunks of things to think of. One, think about if you really do need to do an equity fundraise. Are you sure that is the right thing for you to do? Working through your pitch can actually help you with this because you're going to make something that is investable, and it might turn out that you're not investable by VC standards, and that's fine too. You can run a very successful business without ever doing that, but you should know. Make sure it's the right thing to do because getting equity investment has been really romanticized, and it is not the right way for everybody. Maybe you can push and get revenue. Maybe there's grant financing. Maybe you can utilize debt financing. There's other ways to do it. If you say, okay, nope, I need it. I'm going to do an equity raise. Make your personas like we just talked about. Figure out the right investor persona for you. Figure out your correct instrument. And I know some of you have probably been at previous sessions where there was a lot of talk about instruments, and that is great, right? Do you want to use a safe? Do you want to use a convertible note? Is this a priced round? Know what you want to go out with and know any terms that you want. Usually it's just the cap and the discount are the big ones. Know the time frame you want to raise in. Do you want to go gung-ho 3 months? I'm putting everything aside, I'm raising, and I am done at the end of that time. Do you want to run it that way? Or do you want to do a rolling raise? That's okay too. Maybe you want to open up a safe and take things in, or an RUV and take things in over time. That's fine. Are you use a roll-up vehicle? If I use a term or an acronym you don't know, please ask in the Q&A if you want me to explain it more. Then get your materials together. Create what's called a data room. It just houses all of your documents and materials that someone would want to look at when they're going through diligence on your company and on your deal. Get it in there. Just do it before you even start doing any of your fundraising activities. Just put it together, get it in there. And your pitch, work through your pitch before you're going to start go actively fundraising. Get that story together. Anyone who knows me knows pitching is what my whole life is about. If you have questions on pitching, please come ask me. And think about how you're going to track once you do start reaching out to people. You can use a simple spreadsheet, you can use a CRM system, but how are you going to keep track of who you're talking to and who you're sending material to? You want to have a way to do that. And again, if you set it up before and not in the moment when you need it, it'll be a lot calmer for you. Then you start doing your outreach and keep it in the tracker when you do it. If you start letting it slip, that's when you run into issues because you forget to go back to it and then it's out of date and then it's not really useful anymore. And start with kind of the bottom of your list of targets. Get that practice out of the way. I think that's a better way to start your pitching because you got to get some reps under there. You got to get used to it. And you don't want to do that with your really desirable investors right at the top. Do it with some folks where it's not going to be the end of the world if they're not into what you're doing. And then follow up consistently and make it personalized. Those are the two most important things. You have to personalize communication with investors. That's how you stand out. Takes a little more time, but it's much better use of your time because your response rate is going to be higher. And if someone doesn't respond to you, don't assume that they will. If a week goes by, email them again, right? I've got over 200 emails from real people in my inbox I cannot find the time to respond to. And I wish everyone would continue to email me and ping me because I need it. It gets it back to the top. Right? A long time ago, we used to say below the fold with the newspapers. You're below the fold of the inbox. Get yourself back up there at the top of the fold with a nice personalized reminder. So question 3, how do we create a compelling narrative? This is my thing, but I'm going to go over it at a high level here. Lens to look at pitching through. It is all about storytelling and de-risking. You have to remember the de-risking part. You're putting yourself in the place of an investor. It is not intuitive if that's not a space that you're very familiar with. But investors are looking to make a return on their money. That's the end game of an investment. So they might not ever be your customer. They might not ever buy what you're selling, but they can see the opportunity in what you're doing for them to make more money later than they're giving you now. That's their goal. And then each part of your pitch, every slide you go through should take away risk from the opportunity so that they're more and more convinced that they can make a return on their money, right? They see a lot of pitches and it's not all direct competition, but no matter what they're seeing, they're evaluating how risky each one is against another one. Even if it's a totally different industry from you, they're comparing the risk levels. So you're removing risk. So when we think about storytelling, that's the content that you're putting in there and the way that you structure the narrative. This is our framework. There is no one right framework for this. There is no authority on pitching. You're going to see lots of them. It is not one size fits all. This is what we recommend at Scroobious. It's based on hundreds of interviews with investors, tons of secondary and primary research. This tends to work really well for a Series A or earlier pitch. By no means is it a thing that you must do. By no means will it work for everyone. But at a very high level, these are the core 10 sections and a way to present them that does tend to be very effective and compelling. So the first one is your mission. Why are you doing this? Remember, you as founder, you are the steward of the capital that people are giving you. You are making the decisions. The investor needs to know you as a person. Different when you get past Series A. Series A and before, so important. They have to know, why are you doing this? What is your origin story, right? I shared mine before I started this presentation. It tells you why I care about this and that I am qualified to talk about it. That's part of what's communicated in your origin story. After that, you're going to get into your problem. And by the way, a very common origin story is that you experienced a problem, there wasn't a good solution, and you went out to make the right solution. And then it leads very naturally into your problem section. Here you're going to talk about concrete pain points, acute pain that some group of people, of companies, whatever customer segments is feeling, independent from your solution. This problem has to be big and painful, independent of how you're solving it. Convince someone that it exists, use data. Don't ask an investor to take your word for it. After the problem, you're going to get into how you solve that problem, right? And you're going to make sure that you directly solve that problem you just convinced me of. So that problem has to be something you can actually solve. And again, I do like whole work. Our whole product is this. So there's so much more here. I'm doing this at a high level. But how you directly solve it. After you get through your solution, tell me how you're going to make money with it, because it is an investment after all. So you can be pre-revenue, you can be pre-everything, but how do you plan to monetize this? What is your basic business model? Where does your revenue come from? It has to be really clear. After that, it's good to get into your market size. Market sizing, again, I do a whole workshop just on market sizing. I know it's challenging. I promise you can do it. You don't have to be an MBA to do a bottom-up market size. This is your TAM, SAM, and SOM. I said bottom-up, there's two. There's a top-down and a bottom-up. So much more information on that, but you want to do a bottom-up market size, and I promise you can do it. This is really important because it says if you're investable or not. If you're going for VC funding, you have to have a TAM that is at least $1 billion. Otherwise, it is not really investable because the math doesn't work to get the return that they're looking for. That is not necessarily true for other capital sources. Then you want to go into your competition. Where do you fall in the landscape of who else is doing this? And not necessarily just who else is doing this, but how is your potential customer going to solve their problem? Might not necessarily be another company that you're up against. Why now? This is really important. Why is now the right time for your company to exist? And why is now the time for you to be fundraising? And that's really about your traction. Then you're going to get into your go-to-market. Okay, how are you doing this? Who are you going after first? What channels are you utilizing? There's a lot of important stuff in there that is really centered around customer acquisition. How are you going to reach and acquire your customers? Then your team. It's really nice to bookend your pitch with people. So start with you as founder. Why are you doing this? And then end with, here's the team that I've recruited to execute. So you're really, with your team, showing that you can make these things happen. You have the right people to execute on this. And then thank you. We put it as part of the core 10 because so many people don't have it. Put all your contact information in there. Make it really easy to find stuff about you. Give a sincere thank you. It is an important part of your pitch. There are some core things that are not in here in this 10 section framework, like your actual fundraising ask and your financial projections. They're not in the core 10 for some pretty good reasons. It's not, you need to make them, and they should be in your deck for certain types of pitches, not in your core 10 here because of some pretty specific reasons. Again, I'm happy to talk to anyone else, follow up, or we can answer questions at the end here. If I can make myself go through this fast enough, oh my gosh, I'm going to speed up. So the other side of this is the risk, right? That's what I was talking about. You've got the content and then you have the risks, being aware of both. Risks with your mission is that when it gets really hard, you're going to walk because you're not tied to this in a deep enough way. Risk with your problem is that there actually isn't that big a problem to solve. This doesn't warrant a whole company around it. Risk with your solution is that you can't realistically solve it. It doesn't seem solvable, or your way of doing it doesn't seem like it's going to work. Business model, the risk is that you're not really sure how you're going to monetize this. You don't really have a sense for where revenue might come from, or it doesn't seem feasible, the model that you're using. Risk with the market size is that it's not big enough to support the investment that investor is looking for. Risk with your competition is that there are no other solutions. If you say there's no competition, that is a gigantic red flag. Please don't ever do that, and that you're not differentiated enough. Risk with your timing is that it's not the right time for what you're doing. It's going to hinder adoption of your solution, or that it's not the right time for you to be fundraising, which signals that you don't actually understand that landscape and when your company needs to be fundraising. Go to market risk is that you're not going to be able to reach your customers, or you're going to spend a lot of money on the wrong channels. Risk with your team, you don't have the right people to execute on this. And risk with your thank you is that if you don't have any information available anywhere or any thought leadership, that you might not be a strong enough founder, or you might not be building the base in a strong enough way that you're going to hit the market with stride. Okay, I'm not monitoring the chat whatsoever because I'm trying to go this really fast. So Rachel, I'm counting on you to call anything out. So one other point with your storytelling and how you make things compelling, I talk about this ad nauseum. People are probably sick of me saying it, but use header statements. Don't just put solution, problem. Don't just say, here's how we win. Don't do those things. Make statements. These are real statements from decks where we've worked with the founder. I thought they were really good examples. It's always helpful to see an example. So if you read, benefits are expensive and undervalued, so employers need to increase their cash pay to compete. Clear, statement, direct, concise. Everything else on that slide supported that one statement. Solid, tells the investor what they need to know. If that just said problem, way less effective. Please make a header statement at the top of every slide that tells me the point of this slide in a direct way. Transforms your deck. Okay, moving on. 4, when should we aim to raise our next round? I looked at this in 2 different ways. One is just like how long in between raises. So I gave some average numbers here just so you have a sense. If you're at the pre-seed or angel round, the terms are, you can use them separately, but they're kind of referencing the same thing. The amount is typically somewhere between 50K or 500K. I know it's a big range, but that's what the averages are. That should probably last you 3 to 9 months, right? That's your runway that you get from that amount of money. So you would need to raise more money by the end of that time so that you don't run out of cash. And the signals here that you're looking to give to investors is that you have good idea, you have an MVP, you've got an experienced team who can do this, you have some early traction, and there's revenue potential. If we're looking at seed, that's typically between 500K and 5 million. Again, it's a big range, but that runway should be about 12 to 18 months. And every round kind of thereafter runway is usually about 12 to 18 months. So you're going to want to raise again after that amount of time. The other way to look at it is when in the calendar year should I be looking at raising my next round, because that matters. Fundraising is seasonal. And so you really want to follow the seasons and the school cycle. Fall, peak fundraising time. We are in it. It's September to early December. So this is when kids go back to school. Everyone's got their kids out of their hair again. Everyone's feeling refreshed after the summer and they've got cash to deploy. They're getting back in the game. This is when most fundraising happens. Holidays, bad time. Don't try to fundraise during the holidays. There's no school. Everyone's traveling. It's time off. They're, with their family. Not a lot happens between mid-December and early January. Winter, okay time. It's a decent time. It's a new year. There's a fresh start. There's less travel. It's okay. It's not as active as other seasons, but it's not necessarily a bad time. Springtime is a good time. Again, very active. There's a big rush before everyone knows people are disappearing for the summer to get in those final activities. People are generally happy because the weather's getting better. It's a good time. Summer, bad time. Everyone's away. Everyone's traveling. No one's really doing this. This isn't to say that investment doesn't happen. It does during all of these times, but you should know when the investors' seasons happen so that you're reaching people at a time when they're more likely to be open to investing. Okay, oh my gosh, we're going like right up against the end. I want to make sure we have time for questions. So this is kind of the last section. That question was, how much do we need to raise? I can go through this very quickly because It varies incredibly. Ideally, you want to raise enough to become profitable. In practice, that's pretty uncommon. So the biggest things to think about is how much do I need to raise to get to my next fundable milestone? That's what you want to think about, right? So how much progress, what milestones do we achieve with this money? Is it enough to position us well for the next raise? And that should be tied to your financial projections. That should be, are you hiring? Usually salary is the biggest burn, right? That's the most that you're spending on a raise. So is it in line? Is what you're asking for in line with who you need to hire to make those milestones happen? Okay. So I had some parting thoughts. I'm going to not share them right now because I want to make sure that we get to some questions so we make this as valuable for the audience as we can. Rachel, what are some big ones that came through?
All right, so just looking through the chat, one of the questions that we had was just if you could speak a little bit more on that idea of family offices, what they normally expect equity-wise, where can I find them?
Sure, yeah, and family offices are a little tricky. They tend to rely very heavily on their networks because it's managing a family's wealth, right? So you're really entering a family versus a fund. Some good places to look are usually look for the names on university buildings or the names on hospital system buildings. Typically, that's from a very wealthy individual who likely has a family office. You want to make sure when you reach out to one that there is a very strong alignment, either with what you are building and the strategy of the family, where the family's wealth comes from, their domain expertise, or that it's an area they really care about. Right. So at my last company, we were in the Alzheimer's detection space, and we raised from a family who had that in their family, like a lot do, and really cared about efforts in that space. That's usually the best way to kind of find them. There's also organizations like the Family Office Network, and there's some others that you can start getting yourself, start learning about that space. And some family offices are a little bit more vocal than others.
All right, next question I have is, where did it go? What should I have done before I reach out to an angel investor? When is it too early to share an idea with someone and ask for advice?
Oh, never too early. Some of my angel investors are friends that I first just started ideating Scroobious with, right? For this, we had angels at my last company too, and they tended to be people that were in the university or in the hospital system with the founders and have seen some of their work evolve. In Scroobious, it was me talking to people at the very beginning saying, what do you think about this idea? I think there's something here. What are your thoughts? Or people that I interviewed. You cannot do enough interviews with prospective customers or partners in the space of the startup you're thinking of. They can turn into angel investors, right? I interviewed a ton of angel investors for what I'm building at Scroobious. That was a great fit. But again, broaden that view of who could be a potential angel, because it's more than you think. And asking someone's opinion and asking for their feedback is always a better way to eventually get to a check than just asking for the check.
Awesome. And I know on your end, you might see that timer at the end. We're totally able to go over, so don't panic.
Okay.
But we do have an in-person question. So Sarah.
Yeah. This is a question about the deck and about leading with the problem statement. In my case, I'm starting a gaming company, right? So again, if it's in entertainment, it's hard to say that it's specifically solving a painful problem. So in that kind of scenario, what do you suggest doing?
Well, any company has to be addressing a need, right? So if it's not a problem, it could be taking advantage of an opportunity that you see, right? There's some reason why you started this company, and hopefully you did some validation work to feel good that people are going to pay for your solution, right? So what was that? What did you tap into? What did you uncover? Is it that they are not satisfied with other games in the space that you're playing? Is it something about the way you're making your games, the back end of it, right? Or did you tap into an efficiency or a new technology that's going to like blow other things out of the water, and that's the opportunity? But there, you have to describe in some way why someone would be looking for a different game or a different product than what exists.
So more like jumping sort of straight to the solution part, sort of like what makes us different?
I wouldn't jump straight into the solution. There has to be a need, right? You have to have identified a need or an opportunity either in the industry or, you know, the people who are going to buy your game. Why do they have a need to do that? It has to be compelling, independent of your game.
Sure.
Does that make sense?
Yep. Thank you.
Awesome.
Okay.
We got another one in the chat. It says, would you be able to talk about performing due diligence on the investors before accepting a check with regard to, say, turnaround time, recent investments, what that typical check size might be, or even reaching out to references on these investors?
Yeah, it's always good to do your own due diligence. Absolutely. So if it's an investor, whether it's an angel or whether it's a fund that you don't already know, or you don't have experience with, you want to ask them for things too, right? One of the parting thought that I didn't share here today, but a big one of it is remembering that you are offering someone the opportunity to profit off of the company you're building. You are inviting them to join you. This is your offer. So you own that, and you want to be selective also. It's not, right, you're not in a lesser position than the person writing you a check. You're equals. So don't just jump at everything. Don't jump through all their hoops and not also make sure they're right for you, because they're going to be on your cap table for the life of your company. It's a long time. You want to make sure you've got a good cap table. So ask them for other founders that they've invested in. Can you talk to a couple other founders? And I did this for my investors. I called them up, and for me, I said, in particular, have you invested in any female founders? I would love to talk to them. And that's the type of reference that I ask for. You should ask them, how often do they typically invest? What is their typical check size? What kind of check size might they be interested in for your opportunity? They range wildly for angel investors. Typically, it could be as low as 1K. It's up to you what you want to, accept as an individual on your cap table. If you have a lot of angels who might do 1 to 5K, think about if you want a roll-up vehicle or an SPV, which puts them all into one line on your cap table instead of having all of them individually. Angels can write hundreds of thousands. They can write millions if they want to. It depends on that particular angel.
And then this is a pretty specific question, but at what stage should an NDA be signed when working with an investor?
Yeah, it is a really good question, because it actually can be a red flag if you ask an investor to sign an NDA at the beginning, because it signals to them that you might not be very familiar with the space and you're going to have a lot of learning on the job. So an investor will not sign an NDA before you send them your deck, like the first time, right? Which is part of why I omit certain sections from the core 10, because you want that core to be able to be sent. Without you giving away any trade secrets, or without you putting something in there that might cross a regulatory boundary. So don't put anything in there that you're not comfortable with maybe your competitor knowing, because you don't know what an investor sees. That's part of why they won't sign an NDA. They see too many things to say that they're not going to have competitive information. They don't know that before you send it. And typically the point at which you would ask them to sign an NDA is if you have a data room, and in the data room you have some more sensitive material that you wouldn't want maybe a competitor seeing. Then you say, you know what, I would love to open up. So happy you want to get into diligence. I think we could be a really good match. I'd love to open up my data room. It does have some sensitive information in there. Would you be okay signing an NDA before you see that? A lot of the times they'll say sure. And some platforms like Carta, you can build in, you can say, check off and say, I want everyone to sign an NDA before you let them see this. Sometimes they'll still say, no, I'm not comfortable because XYZ, or our fund just as a rule doesn't sign NDAs. And then you have to decide if you're comfortable still sharing that information.
Awesome. And I think we're going to wrap it up with one more in-person question. So,
okay. Hey, Allison, it's Manisha. How are you? And I think you'll love this question. So when circulating the deck around, do you suggest having two versions of a deck, a longer deck and a shorter deck? And what's your take on the 2-pitch video that should accompany the deck?
I feel like I did not pay her. I didn't pay her to ask those questions.
No, I know. She didn't pay me.
Because I talk about this all the time. So a lot, you will get advice to have two different versions of your deck. My point of view is, as the founder, make your life as stress-free as you can. It has enough stress already. When you have two separate files that you're maintaining, if you make a change in one of them, which you will because a pitch is a living document, you have to remember to go make that change the way you want in the other one. Undoubtedly, you'll forget at some point. You're going to send it to someone, and then you're going to be mad at yourself, and they're going to have something you didn't want them to have. It's a headache to maintain different files when you're changing information. It's not static. So there is a happy medium, right? The way that we teach what you put on a slide has enough information, enough context, words, that it can stand alone. Someone can understand the point of the slide without you explaining it or without a chunk of text. Those header statements really help. And it's not overwhelming to look at such that it would distract from your presentation. There is absolutely a happy medium there. I really recommend making that core, and then what you can do is have an appendix with as many slides as you want in there. You can have 100 slides in there. Depending on the point, the goal of the pitch, you can move slides in, PDF it, send it, move them back out. Right? So you have one file. You only have to change that one file, but you can modify it, and then you send the PDF so you know what you sent. That's version control. And then you pull those slides up during Q&A as well. You look like a rock star, right? If you get asked a question about something that wasn't in the core and you're like, oh, great question. Let me pull up this slide. We'll talk all about it, because you already have that prepared. Awesome. So that's my view on send ahead versus not. If you're in a scientific field, or you have something where more information really would be helpful, or you need to show some graphs or some charts, or maybe you have a video or a demo or something, separate document. You can send that ahead if you want. Chances are people are not going to read it. They're just going to skim it. Remember, someone gives you 3.5 minutes on average, and that's generous to look at your deck. You send a deck full of text, they're not reading it. They're just not going to read it. And then the video, I highly recommend people make a pitch video. There are free tools out there. We have people make them on our platform, but you can do it for free too. Just find software you like that simultaneously records your webcam and your screen. I'm partial to Soapbox by Wistia. I like the dimensions they use. I don't like when you're in a little bubble and you're covering up content. And you want to give your pitch as if you were pitching to an investor, not produced, don't put music over it, not heavily edited, just 5 minutes or less, you presenting your slides, send a link to that, ask someone to check it out, and then say, hey, is it worth meeting? Qualifies the meeting for both sides and lets you be a person. You communicate so much more information. We are so much better at visual information than we are static. And it is a great asset to use for fundraising.
Awesome. Thank you so much, Allison. I know I asked you to run a marathon in an hour, and you definitely did it. So thank you so much.